Welcome to FX Tech's comprehensive GBP USD analysis for the week of November 17th to 22nd, 2025. This week marked a critical turning point for sterling as technical and fundamental factors aligned to create a decisively bearish setup. We'll examine the key price action, analyze the impact of UK inflation data and hawkish Federal Reserve minutes, review technical breakdowns including a looming death cross pattern, and provide actionable trading strategies for the weeks ahead. Our analysis integrates insights from 5 leading data sources: TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex, to give you a comprehensive market perspective. Whether you're a trend trader, range trader, or swing trader, this analysis will equip you with the levels, scenarios, and risk management tools you need to navigate the current market environment. Let's dive into the details. The week of November 17th to 22nd was marked by significant bearish pressure on GBP/USD. Sterling broke decisively below the critical 1.30837 to 1.30956 swing area, a zone that had acted as both support and resistance throughout the preceding sessions. The pair tested the November low at 1.3009, before staging a brief recovery attempt on November 21st. However, this recovery stalled at the 100-hour moving average at 1.31085, with sellers quickly regaining control. The weekly range extended from a low of 1.3038 to a high of 1.3215, representing approximately 177 pips of volatility. Most significantly, a death cross pattern is forming, with the 50-day exponential moving average poised to cross below the 200-day EMA, a technical development that historically attracts longer-term bearish traders. Market sentiment is decisively bearish, with a 65% probability of further downside in the near term. On November 19th to 20th, the UK Office of National Statistics released October inflation figures that showed a notable cooling across multiple measures. The headline Consumer Price Index dropped from 3.8% to 3.6%, marking the first decline in 5 months. Core CPI also fell to 3.4% from 3.5%, while the Retail Price Index declined to 4.3% from 4.5%. Sterling weakened immediately following the release as traders recalibrated their expectations for Bank of England policy. A Reuters poll conducted after the data showed that most economists now expect a 25 basis point rate cut at the December BOE meeting. The probability of a December cut surged to 80%, up significantly from earlier in the month. This dovish shift was reinforced by the fact that Catherine Breeden had already joined the dovish camp at the November 7th meeting, where the vote to hold rates was a narrow 5-4 split. During this week, the Federal Reserve released minutes from its most recent FOMC meeting, providing detailed insights into officials' deliberations. The minutes revealed extensive discussions about the merits and demerits of cutting interest rates, with particular attention to balancing growth support against inflation concerns. Critically, the minutes cast doubt on whether the Fed would proceed with a rate cut at its December meeting, a development that surprised some market participants and provided significant support to the US dollar. The hawkish tone suggested that Fed officials are in no rush to ease policy, especially given resilient economic data and persistent inflation. British pound to US dollar dropped sharply to 1.3053 following the release. The contrast between growing expectations for Bank of England easing and the Fed's higher-for-longer stance created a policy divergence narrative that became the dominant driver of sterling weakness for the remainder of the week. 4 key technical developments defined this week's price action. First, on November 19th, GBP USD broke cleanly below the 1.30837 to 1.30956 swing area after interacting with this zone 8 times on the hourly chart. This breakdown triggered accelerated downside momentum, with the pair reaching a session low of 1.3052. Second, on November 21st, a double bottom formed at 1.3038, and the pair briefly recovered back above the swing area. However, this bullish attempt stalled at the 100-hour moving average at 1.31085, with sellers regaining control. Third, the death cross pattern is forming, with the 50-day EMA breaking down toward the 200-day EMA, a development that attracts longer-term bearish traders and historically precedes extended downtrends. Fourth, the pair has moved below the Ichimoku cloud, the 38.2% Fibonacci retracement at 1.3156, and the 55-week exponential moving average at 1.3184, signaling that the correction may be complete. Our analysis integrates insights from 5 leading technical sources, and the consensus is remarkably uniform. Investing Live maintains a bearish bias, highlighting the swing area breakdown with downside targets at 1.3009 and 1.2941. Action Forex adopts a neutral bearish stance, identifying 1.3008 as critical support, with targets at 1.2831 and 1.2474 based on the 138.2% projection. Forex.com takes a neutral view, characterizing the 1.3000 to 1.3100 zone as a decision area where pivotal support is being tested. Daily Forex is bearish, emphasizing the death cross pattern forming below 1.3200 with a downside target at 1.2955. TradingView also maintains a bearish outlook, viewing price action below 1.3200 as downtrend continuation toward 1.2950 to 1.3000. The key takeaways are clear: unanimous bearish to neutral bearish bias. Critical support at 1.3008 to 1.3009, primary target at 1.2955, extended target at 1.2831, and invalidation only above 1.3247. Understanding critical support and resistance levels is essential for effective trading decisions. On the support side, the double bottom at 1.3038 represents a definitive line for sellers. The November low at 1.3008 to 1.3009 is the next key level, with a break targeting 1.2831. Below that, we have the 50% Fibonacci retracement at 1.2955, the 50% midpoint of the 2025 range at 1.29414, the 138.2% projection at 1.2831, trendline support at 1.2760, and the long-term 38.2% retracement at 1.2474. On the resistance side, the 100-hour moving average at 1.31085 is where price stalled on November 21st. The 200-hour MA at 1.31297 is the next target for buyers. Above that, we have the 38.2% fib retracement at 1.3156, the 55-week EMA at 1.3184, psychological resistance at 1.3200, and the critical support turned resistance at 1.3247. Where a firm break would suggest the fall from 1.3787 is complete. For the next 1 to 2 weeks, we see 3 possible scenarios. The bearish scenario, with a 65% probability, expects the pair to test and break below 1.3008 to 1.3009, targeting 1.2955 as the primary objective and 1.2831 as the secondary target. Key drivers include the death cross completion attracting longer-term sellers, the 80% probability of a BOE rate cut in December, technical momentum favoring bears below 1.3085, and resistance at 1.3200, keeping the downtrend intact. The neutral scenario, with 25% probability, sees range-bound trading between 1.3008 and 1.3200, driven by the double bottom holding at 1.3038, mixed economic data, and consolidation after the sharp decline. The bullish scenario, with only 10% probability, would require a break above 1.3247 to suggest the correction is complete, potentially driven by the BOE holding rates, a Fed dovish pivot, or a technical reversal above moving averages. Looking 1 to 3 months ahead, the outlook depends heavily on the policy paths of the Bank of England and Federal Reserve. Scenario 1, the sustained downtrend with 50% probability, assumes the BOE cuts 25 basis points in December and signals further easing in Q1 2026, while the Fed holds rates steady through December and into early 2026. With UK growth sluggish below 1% and the US economy remaining resilient, this scenario targets 1.2831, 1.2760, and ultimately 1.2474 over a 1 to 3 month time frame. Scenario 2, range-bound consolidation with 30% probability, sees both central banks adopting a more balanced approach, with the BOE cutting cautiously and the Fed beginning modest cuts, reducing policy divergence and leading to consolidation between 1.2800 and 1.3200. Scenario 3, reversal and recovery with 20% probability, would require the BOE to hold rates or the Fed to turn dovish, potentially driving a recovery toward 1.3400, 1.3500, and 1.3725. Let's translate this analysis into actionable trading strategies. For trend traders with a bearish bias, the primary strategy is to sell rallies toward 1.3085 to 1.3100 or 1.3150 to 1.3165, with stops above 1.3200 and targets at 1.3008, 1.2955, and 1.2831, offering a risk-reward ratio of 1 to 2 to 1 to 3. Alternatively, sell on a retest of 1.3008 to 1.3030 after an initial break, with stops above 1.3080. For range traders with a neutral bias, buy near 1.3008 to 1.3038 support, and sell near 1.3150 to 1.3200 resistance, with stops below 1.2980 for longs and above 1.3220 for shorts, targeting the opposite end of the range for a 1 to 1.5 risk reward. For swing traders, sell on a confirmed break below 1.3008 with stops above 1.3080, or buy on a break above 1.3247 with stops below 1.3150. Risk management is paramount. Risk only 1 to 2% per trade. Always honor your stops, take partial profits at intermediate targets, and reduce positions ahead of key events like the BOE December meeting, US employment and GDP data, and Fed speeches.